it plays a part in your day-to-day lives. So let's get into it. So what is credit? Of course, credit, as you guys know, is the ability to secure a good and or a service without any upfront payments. That's the long and the short of it. But let's take a look at overall. So credit is the ability to secure, like I said, capital, goods, and services without any upfront costs, which is a beautiful thing. That means we can use someone else's money in order to be able to get the goods and services we need, and also generate cash generating assets as well too, like trucks. So with an ability to make a principal or full payment at a later predetermined date, often with interest attached. Sorry, I got tongue tied there. Office off Often with interest or risk of financial penalties if you don't pay your bills on time. So the long and short of it is credit is the ability to get a good or service without any upfront money. All right. So now what I want to talk about is, let's talk about what actually makes up a credit score and the overall spectrum of credit scores. Let's take a look. So credit score scale. So credit scores actually go from anywhere from 300 all the way till 850. Of course, 300, as you guys can see, would be a very bad credit score, a very bad situation, because anyone who does have a 300 credit score, or as we call a subprime credit score, they're not going to be able to get things like credit cards, loans, assets of any kind, because of the fact that financial lenders see them as a risk, of course. Now, of course, on the flip side of that, anyone with an 800, 850 credit score, they're going to be able to get anything they want. They're going to be able to get the best credit cards. They're going to be able to get the best loans with the best interest rates and the best terms. They're going to be able to get that mortgage with the best interest rate over that 30-year term. They're going to be able to just go out and get a cash generating asset, for example, like a truck, or like real estate, like crypto, anything that is cash generating. They're going to be able to just get, and they're going to be able to use other people's money in order to be able to get that. This is the reason why it is so important to have good credit, because your credit can actually support you just like a job would. Instead of going out and getting a job, you go out and get a cash generating asset like a truck, and that now is your overall income. So just like I said, we have a full spectrum here. We have 300 to 499, of course, is going to be very bad. You have 500 to 579. You have 580 to 619, which is going to be poor. Fair is going to be about a 620 to 679, whereas 680 to 699 is going to be considered good. 700 to 799, very good. And excellent, of course, like we talked about, is 800 to 850. So with all of this, guys, now that we kind of see the spectrum and see what plays a part in it, some things that I do want to call out is the vast majority of consumers that we are going to be talking about today, unfortunately, they are going to fall under that fair to very bad range. They're going to fall into that side of subprime credit. And this is what I want to show you guys, that there is a way out of being in that subprime credit category by leveraging the laws that protect you as a consumer. And that's what we're going to be talking about today. So let's keep going. So what determines a credit score? First of all, one of the biggest things that I cannot stress enough during this entire process is, guys, you are in control of your credit and credit score. I want to say that again. You are in 100% control of your credit and credit score, because of the fact that credit scores are built up of variables and different things. But luckily enough, we as the consumers, we can control those variables. And I'll explain what I mean here in a second. So first of all, let's talk about the biggest piece of how your credit score is determined. The biggest piece of how your credit score is determined, actually 35%, is going to be your payment history. That payment history is going to be crucial in building good credit. Now, don't get me wrong. I know that we may have a late payment or two, and we'll talk about how to get those off here in a little bit. But any and all bills, as you are going through your credit restoration journey, make sure that you are keeping your bills up to date. Make sure that you're staying current on your bills. If you have to call the lenders and ask, hey, can I move the due date to here, this and that, do that way to make sure that you never fall behind on a payment. Now, something that I do want to call out with the payment history is the fact of, if you do miss a payment, there is ways around it. I don't want you guys to panic, but there are ways around it to be able to still get that positive payment history. So we'll talk about those here in a minute. But remember, 35% of your payment of your credit score is determined by your payment history, and that's the payment history over the last 24 months or the last 2 years. Okay. So next is going to be a one that I know you guys know a lot about, or you heard a lot about, especially as of late: credit utilization or capacity of amount owed, which basically means the amount of your credit that you have versus the amount of your credit that you use. That makes up 30% of your credit score. So between your payment history and your overall utilization, that's 65% of your credit score that you can manipulate just by making your payments on time and just by reflecting that you're not using a lot of the credit that is able to be given to you. Now, I know you're saying, hey, Larry, you're saying that we can leverage our credit and do all these things, but you don't want us to use our credit. No, that's not what I'm saying. So let me break it down for you. So there is something called a statement date. Everyone knows a due date, but very few people know about your statement date. Your statement date is actually the date of the credit reporting agencies getting information from your lenders saying how much you owe. So by the statement date, you want to make sure that your credit score, you want to make sure that your utilization is at an appropriate level. What I mean by appropriate level, something that most lenders and most people, financial people, will tell you is you need to be, under 25 to 30% utilization. And 25 to 30% utilization, you'll hear mortgage lenders and a lot of other people tell you that. But what they're not telling you is that is actually just to maintain your current credit score. It's not actually helping you. In order to actually help you with your credit utilization, you want to be anywhere from about 0 to 9%. 0 to 9% reflected utilization. Now, there is ways that you can definitely hide your utilization, and we'll get to that on another call, but you have the ability to do it. But what you want to make sure you do for sure, regardless of anything, is you want to call your lenders and make sure that you know what your statement date is, because that is the date that your information is going to be reported to the credit reporting agencies, and that's what's going to reflect on your credit score. So remember, guys, 65% is able to be manipulated by making sure your payments are done on time and making sure by the time your statement date comes around that your balance is almost within that 0 to 9% range. Okay. Next, we have the length of credit, which is basically your age of your credit. Now, this is also another area that can be manipulated by us as well. So currently, right now, we're looking at about 80%. 80% of the credit score can be manipulated by you, the consumer, which means you have total power over your credit score, which is amazing, because that means you now control the narrative of what is reflected on your credit score, which is beautiful, because of the fact credit is meant to empower you. It's not meant to hinder you, and it's not meant to take, your power away. It's actually meant to empower you more. So the length of credit is actually going to be your credit age. Now, I know a lot of you have heard of things like trade lines and everything like that. And like I said, we can always do another call on that one. But understand the fact that the length of your credit age is about 15% of your overall credit score. So the longer you have credit lines, the better it looks on your actual credit score. Okay. Next, we have new credit. So this is actually going to be inquiries. This is actually going to be for any actual hard inquiries that are on your credit report. Those are going to be within the last 12 to 18 months. And those are going to reflect as new credit on your credit report. This is also able to be manipulated as well. So what are we at about? I think 90%. So 90% of your credit score can be, like I said, can be dictated by you. Now let's keep going. So we have payment history, credit utilization, length of credit, new credit, which is the inquiries like we just talked about. And now we have types of credit used, which is basically a mixture of your revolving credit, your credit cards, your installment loans, all of those different credit products. Those are going to be what make up this last 10% of the type of credit used, which means the more mixed your overall credit profile is, the better it is. Now, I do want to stress something as far as just giving you a little side note. When you are, say, going for funding, or when you wanting to build up your profile to be in a lendable position, you want at least 10 positive accounts. 10 positive accounts that are a mixture of revolving and installment loans. So make sure that you have a mixture of those different credit products on your credit score. The better that mix is, the stronger you look to the lenders. Okay. All right. So now let's talk about, let's get further into the credit report itself. So basically, the long and short of it is when you have good credit, you have the ability to have good things like you're more likely to receive reward-based credit cards, which is we all know, we all love hearing about the Apex miles and the frequent flyer miles and the cashback rewards and all these different things that are afforded to people who have great credit. Because of the fact that they have great credit, they get so many more perks that the average everyday person is not going to get. So when we go out and we spend, money on a truck, when we spend, money on a car for tour or what have you, using and leveraging our credit, we do get things like cash back. And you can only imagine using your credit to purchase a truck, putting a down payment on a truck and getting cash back for that. You get paid to use other people's money, and it is definitely a beautiful thing. But you, as having good credit, you will have the ability to get things like those personal loans, those business lines of credit, and those other credit products that that you are looking for in order to be able to start your business, in order to be able to scale your business. So let's keep going. So, and one other thing that I do want to call out is you get to save money. Like, I really want to stress the fact of something. Remember that the banking system is dependent on you, the consumer, and you will see why that plays a really big part here in our later conversation. But the banking system is 100% dependent on you, the consumer, which means that if you have good credit, because of the fact that you do have good credit, the banking system is going to reward you in so many different ways. Like, for example, lower interest rates. And you'll see how that plays a part in our everyday life here shortly. But lower interest rates alone, not to mention, the rewards, the cashbacks and all that stuff. The lower your interest rate is alone, the more money that you are going to save and the more money you keep in your pocket and keep out of the bank's pocket. Okay. So now let's talk about some things that go on with bad credit. Bad credit, you're less likely to get any credit products. Let's just be honest. You are less likely to get any credit products whatsoever. And if you are lucky enough to get a credit product, it's going to be a subprime one, which means it's going to have a severely high interest rate. It's going to have, no cash back, no rewards, miles, and anything like that. And it's basically just going to be the equivalent of almost a debit card, which I do want to throw out that, guys, this is just a side note. Please make sure that debit cards are one of the worst financial vehicles that you can have, because I really want you guys to think about something as well too. And I'll get back to the presentation in one moment. But a debit card is one of the worst financial products that you as a consumer can use, because the debit card is going to give you people direct access to your account. Direct line to your account. Now, one of the main reasons why we stress leveraging credit and using credit so much is because not only do we get benefits from it, like we get paid to use other people's money, but also we put up a veil of protection around our actual money. So here's the thing, case in point, I give you this. If I were to use my debit card at a gas station or wherever restaurant, and that restaurant gets compromised, or somebody in that, in that establishment gets a hold of my debit card, they have direct access to my bank account. And I guarantee you the bank is not going to be forthcoming with giving you your money back, finding out that somebody got your card. And if anyone's ever gone through identity theft or had their card or bank account compromised, you already know it is a terrible headache to deal with. And sometimes you may not even get your money back. Versus using a credit card, you use somebody else's money to, fund your day-to-day life, and then you pay that back at a later date. But the good part about it is when you use someone else's money, for example, a credit card like the bank's money, you then create a veil of protection against, fraud and everything else. Because here's the thing, the bank is not going to fight when they say, oh, well, you had a compromise on a credit card. They're just going to put the funds back in your credit card account and say, we'll deal with that merchant or we'll deal with that entity, and you don't have anything to worry about. The process for disputing stuff with a debit card versus a credit card is night and day. So if you are in a position where you can get a credit card now, minus the disputing that we're going to get into, go ahead and do that. Don't have a direct line of somebody don't give somebody a direct line of access to your bank account by using a debit card. That was just my little soapbox. All right, let's get back to it. All right. So back to some issues with having lower credit. With having lower credit, of course, you are not going to be, like I said, you're not going to be able to get the loans, the good credit cards, and all those different things. But also, too, you're going to have to deal with, like we keep saying, subprime lenders, which we all know the nightmare of payday loans and stuff like that, or predatory style lenders. They're going to be like, oh, well, we'll give you, $1,000 today, or $1,500 today, or $2,000 today, and then you realize that the interest rate is like 200%, and it's ridiculous because of the fact you're paying more in interest than you ever took out in the first place, and it becomes a vicious cycle and a deep hole that you're having to dig yourself out of. So stay away from the predatory style lenders and the payday loan companies, because they will not help you in the long run. All right. So we already talked about extremely high interest rates. Once again, I cannot stress enough how important it is to understand how interest rates really play a part in all of this and saving you money. And I really want you guys to think about something here. The banking system itself is not, the banking system itself is not supported by the rich. I know that sounds crazy, but it's not. The rich has actually monetized getting stuff for free. The richer you are and the better your credit is, the more free stuff you get, versus if you have no money and you have bad credit, they want you to pay for everything. And if they do give you some money to, lend you some money, they're going to charge you a crazy amount of interest. And that's all free money going back to the bank. So you're basically just feeding the bank free money over and over and over. The more fees you have, the higher your interest rate, that is just free money back to the bank. And that's just free money out of your pocket that you could use for an asset, for, taking your kids or your family on a vacation or something like that. You want to make sure that you're keeping as much money out of the hands of the banking system as possible and keeping it in your own pockets. Remember, we don't use our money to do things. We use other people's money, and we leverage credit in order to be able to get all of the things that we want and all of the cash generating assets we want. I will tell you personally, my money is only used for a few things. One, education. Two, a business opportunity. Or three, an emergency. Outside of that, it's credit on everything. All right, let's keep going. All right, so I really want, so now what I want to do is show you the importance of interest rates. So I'm going to take you through a quick case study. So right now we are talking about a brand new, imagine this, you guys are going to the lot and you want to buy this brand new,